Okay, just a sec. Okay, and we are live. So good morning, everyone, and welcome to another episode of the Crypto Hour. So we didn't have a session last week. So today I'm going to go back and also have a look at some of the things from next week. In particular, today we are looking at two aspects that are very important for growth in a general economy, and those are money printing and credit creation. Okay, so let me go straight into a couple of things first. So first of all, we'll have a look at the economic calendar. Oops, just move always. The Zoom controls are always in the way. Okay, so this is the economic calendar for last week. Okay, and then we'll go on to the one for next week. So we keep the overall indications, and that we keep having decent economic numbers for the US in terms of both kind of the GDP figures that came up at 2%, kind of like much higher than expected, and also job numbers, kind of like unemployment claims, lower than expected, and in general we see inflation figures in all countries pretty much, with just one or two exceptions going down and getting kind of lower numbers. We can see we had last week numbers from Canada, and inflation is dropped from 4.3 to now 3.8, 3.9%, and also kind of like numbers for GDPs for Canada, which are a little bit less than expected. This week it was a kind of a short week because of the 4th of July holiday in the US. So there was very little activity in both on Monday and Tuesday. And all the kind of news releases are concentrated on the latter part of the week. Now, the one thing to be noticed, though, and this is kind of like worth of note. If you see here at the top when it says the manufacturing PMI, so these are the kind of manufacturing numbers, and you can see they came up much lower than expected. When if you think about 50 is the parity. So any number below 50 shows contraction, and any number above 50 shows expansion. So although we are having kind of like positive numbers of employment, of GDP growth, and so on, we need to make a distinction between the numbers that are coming from government and then the money. The numbers are coming from the private sector. So manufacturing is quite important in the sense that they have a very tight pulse on the demand side, okay? Because obviously they are not going to produce goods that they don't think they're going to be able to sell. So this is generally seen as a leading indicator of economic activity, okay? And it's kind of like there's a divergence between the general numbers, okay, or going up, jobs are going up and everything, GDP is going up, but at the same time we see manufacturing going down. So is some of the those kind of warning signs that we should really pay attention to. As there was kind of like holiday on Tuesday, so not much was happening. We keep hearing from the US, because they got this, basically their policy is being confirmed. So everything at the moment, everything is working out. If you are the monetary committee in the US, because they are the kind of the best case scenario, and so they keep talking tough. All right, they're saying, well, the numbers are supporting us, so they're saying we are going to keep tightening credits or raising interest rates. They're talking about 2 interest rate raises before the end of the year. The market doesn't believe them, but anyway, they are still trying to make us believe that they are going to be tough and they're going to make everything harder so that inflation can come down to the 2%, which is a target rate. And also, again, yesterday we had some more figures of unemployment, so kind of jobs, and some of them were positive, and some of them were negative. So we see the job opening numbers kind of lower than expected, about 500,000 less than last month, and about 100,000 less than the forecast. But at the same time, today we had a very important release, which is the non-farm employment change, which is probably one of the more important announcements of the month. Always tends to move markets quite strongly. And yesterday there was this kind of the private, it's almost like a pre-release from. So it's still kind of the change in the number of employed people, excluding farming and government. But this is kind of released before the official release, which is going to be today. And if this is going to translate into the official numbers today, then it's going to be quite a big number, because it's double than the expected number. So quite a big surprise on the forecast. So we'll see. What I'm telling you is that if you do play the markets, be careful about between 1 and 2 o'clock, because this moves everything. Okay, it's not just US related. Mainly is US related, but also things that are not directly US related. Prices of, for example, precious metals, oil, currencies, even not connected to the dollars, generally move quite a lot when this is released. So be careful. And you probably noticed that today in the morning, before the release, the market is going to be quite subdued, because obviously nobody wants to take long-term positions that could be scattered completely by an announcement that doesn't go their way. Okay, so we're going to be a quiet market in the morning, and then after there's going to be mayhem for half an hour after the news release, and then things will start their normal range again. Now, before we go on to kind of the talking about credit and money creation, there's one thing that I wanted to remind you, and unfortunately I have to, kind of not that I want to bring bad news, but I need to let you know, because this is, we keep having hacks and people trying to get hold of your crypto, and they can becoming more and more sophisticated. Now, we just had in our community somebody, unfortunately, that was targeted on Discord for one DeFi opportunity that they were in, because they always pose the hackers, the scammers always pose as customer services on Discord, or they'll send you, like in this case here, like in this article, they send you a link to get an airdrop or for something like this, something that looks genuine. But the thing that you got to be careful of is that almost like without fail, this will send you a link, and that will take you to an official looking website that will ask you to put your wallet address and generally your seed phrase. Okay. Now, I just wanted to remind you that there is no reason ever, just remember this, that you should share your seed phrase with anybody. Okay, your seed phrase is your wallet. That's it. I can't put it any plainer than that. Okay, so for those of you that are not in crypto, when you create a crypto wallet, you have to write down either 12 or 24 words in a certain order, and those words represents your wallet, so that if you lose your computer or something happens, you can then recreate the wallet with those words on another computer. Now, if you give those words to somebody else, it's just like giving somebody access to all your bank accounts. Okay, so they can then do whatever they want with the coins that you have in that wallet. Okay, and this is exactly what happened to one of our community members last week. Exactly that. Somebody was trying, was posing as it was a helper from a Discord community. They say, oh yeah, I can help you. Click on this link, put your seed phrase on there. We did, and within seconds, really, everything was drained from the account. Okay, so I don't want this to happen to you as well. So just remember, I'll say again, never, ever, ever share your seed phrase with anybody else, ever. Okay, the only reason the seed phrase is only there for you, and you might need it only if, for example, you change computer and you want to put your wallet on a new computer, then you will need the seed phrase. But it's always just for you. So don't ever give it to anybody else, because you give them access to all your digital assets that you store in your wallet. Okay, now, having said that, let's move on to something else. Where are we? Okay, now I just want to say that as I told you before in other cases, growth comes from labor and increasing the kind of labor force, and at the same time increasing productivity. Now, we've had in the Western world, both trends have been going down for years and years and years. Okay, so obviously the population is getting older, so the number of the labor force is getting actually smaller, and at the same time, the productivity has been going down for a long time. So each worker produces less than what he produced 10, 20, 30 years ago. So as a economy, the way that we have kind of like offset this lower productivity has been by printing money and creating more and more and more money. Now, there's a difference between kind of like government printed money, so to speak, and money created by the real economy. So money that actually is spent in the real economy. That money is created mainly by you taking on, for example, new loans. If you ask for a mortgage from your bank, that is money that just didn't exist before. Okay, so you create it, poof, like this, out of nothing, and that money is now in the economy and spendable. Okay, so the money that you create from the mortgage is now being added to the economy and being spent on, whatever it's spent on. The other way that money can be generated in the real economy is by looser fiscal policy. Okay, so if you have to pay less taxes, you have more money to spend. Okay, so that's easy to understand. Now, if you can see here, when money becomes tight, or in difficult conditions where people are not sure about how the economy is doing, if they're going to have more money tomorrow than they have today, there are two things that happen. Okay, one is generally because the credit market is tightening, so loans are more expensive and taxes are higher, etc., etc. There is less money to spend. But also, if you're not sure about if you invest in anything, if you're not sure if that thing that you invest in is going to be worth more 1 year down the line, then you probably hold back, and instead of investing, maybe you pay off some of your debts. Okay, so that is not a productive way from the general economy to actually use money, because the economy needs to kind of, the faster it works, the more wealth it produces. But if you don't employ your money to buy stuff, then that doesn't happen. Okay, so that slows down the economy instead of making it accelerate. So now what we are seeing now is we have a kind of like in the G5 countries, we got a credit impulse. So the year-on-year change in real economy money, okay, that generally is a lead indicator of the earning per share growth. Okay, and as this credit impulse now is turning negative, this is what then we will see in the earning per shares in the American market, especially, but also in other markets, that in 2023 are expected to turn negative. Okay, so we've been in a kind of like a bull market for shares, kind of like in a way this year. But again, the market doesn't seem to have priced in any kind of like bad news event. So they think that the Goldilocks the Goldilocks event is what's going to be happening in the economy. So not too hot, not too cold, just right. Okay, and this is what they're planning. But if we look at the different economies in the world, we can see that the credit impulse in Japan, in the UK, in Europe, and in the US is now negative everywhere. Apart from, Japan is maybe a case slightly different, where they have an easy monetary policy for many years, and although the inflation is going up, they're not raising interest rates. They still have actually negative interest rates in Japan. So it's a slightly different case, but still it's very close to zero, where in UK, the US, and Europe, now we have negative now credit imports. What's holding everything up, is China. So the other member of the G5. Okay, China is trying to kickstart the economy, and so there's a kind of like positive credit impulse. But China is also a slightly different case because it's a communist economy. So the how people can accumulate wealth is not by having a higher salary, okay, because their salary is limited, but it is by kind of like invested in property. So people have been accumulating money by buying properties, because with the expectation that the property market would carry on going up and up and up. Now, although we are now kind of the bubble is bursting on the property market in China. So what's happening is that all this credit impulse is not generating new growth in China, because is mainly what I was talking about before. It's being used mainly to deleverage, so to pay off loans rather than to invest into new enterprises or trying to make and generate more money. Okay, so let's go on to now credit and credit spreads. Now, what are credit spreads? The difference between the price that the private sector pays for credit and the kind of risk-free interest rates that are available, for investors to get a return from. So it's the extra return that investors expect from the private sector to give a loan to companies and so on. Now, let's say this historically, I can say these kind of credit spreads have peaked at times of economic uncertainty. Okay, and sometimes start a little bit before the actual event happens in the real world. But there is always, like it happened in 2000 and in 2008 and in 2015, 16. Okay, but there are also other peaks that are not quite as clear to understand why they happen, because there's nothing really bad that happened before, straight after. Now, what we see now at the moment, still, although there is uncertainty, this hasn't played out in the credit market as such. And then this is kind of, we need to understand why this is happening, okay? Because at the moment, the credit spreads are quite tight, and levels they have been tight for a long time. And this is part of the reason why this is happening, and why maybe all the raise of interest rates that we've had recently haven't had an immediate effect on spending, is because we had for so many years, we had interest rates so close to zero that many companies have locked in those interest rates in long-term loans. Okay, and so what's happening now is that obviously, when there is a raise in interest rates, obviously that applies to new loans, but not to old loans. Okay, so that is felt whenever, what you know yourself for your mortgage, if you have a kind of like a fixed rate mortgage, even if now the interest rates are higher, you still pay the old rate until you have to renew your loan. So you have to get another deal, and now instead of paying maybe 1% or 2%, have to pay 6 or 7. So there is a lag between when the costs are increased for borrowers and when the borrowers have to actually pay the increased costs. Okay. Now, what we see, these are the kind of the figure that you were seeing before in the previous graphs. Okay, and this is the lending office, the senior lending officers being surveyed to report what the lending standards are in the banks. As you can see, although these credit spreads are kind of quite low, the money that's requested by banks when you apply for a loan is actually peaked quite a lot. Now, that is not telling you everything, because bank lending is about 40% of credit, really. Okay, but still, this is the cost of the new loans, and it's just pointing to again, increased costs of doing business, because it's fine if you have got a long-term loan in when the money was extremely cheap, you still carry on as normal. But if you have to ask for a new loan, as you can see, we're talking about more than double, 2.5 times the cost. So this has then an effect that will not be seen straight away. Again, it's not immediate whenever they raise the interest rates and the effects are felt in the economy, but it will be felt like 12, 15, 18 months down the line. And again, it will show us kind of lower earning per shares, again, when there is the earnings are reported, with the quarterly or yearly filings from companies that are on the stock exchange. Now, what are expectation? And expectation that kind of, I personally believe they are rosier than what is really going to happen at the moment. As for 2023, to show a flat earning per shares. Okay, so earning per shares to have 0% growth in 2023, and then in 2024, we're expectations are of an 11% growth. Okay, so even the best case scenario at the moment is 0 growth. Okay, and that for me is really rosy. So believing that everything, absolutely everything, will go exactly according to plan, and nothing bad is going to happen. Now, as you can see, although if we look at sectors that are a little bit more in trouble, like these are commercial mortgage-backed securities, we can see that the cost of financing these is gone up considerably, from about 250 basis points to over 700. Okay, and this is to do with the problem is, as I told you before, in this commercial property sector in the US, but also because of the problems that some of the banks are finding themselves in, because they finance the commercial property deals in the US, and this in particular affects the US regional banks, so the second tier of banking, not the big giants, the Bank of America and JP Morgan of this world, but the smaller banks in the US, quite a few of which have already failed, and more are going to go to ground, because the commercial sector now is facing some really tough choices, because as I was talking to you before, there's going to be many hundreds of billions of loans that need to be refinanced next year, and going from near 0 interest rates to 5-6% is just going to make some of these loans unsustainable, so they will become bad loans, and then that will trickle back into the bank's balance sheet, and then again it's going to start as more small, we hope, or it could be a big cascading effect that will affect the banking sector. So now, as you can see, the earnings per share growth now is expected to turn negative in 2023. So the market expectation is 0. Okay. Now, I personally think that we are going to be quite a little bit below the neutral level for 2023. Although we'll see then again pick up in 2024, and this also will apply to the earnings growth of the S&P 500, and again we are expected to see somewhere around the between -5 to 0. So somewhere around that figure. And not only that, but you see why this is happening is because basically the credit standards, so the cost of credit to US corporates is going up. So and this is what we're seeing sometimes, the manufacturing companies, because manufacturers need to pay up front before they can sell the goods they have produced. So they need to actually invest capital in their stock, and they kind of like at the moment they are holding back a little bit because they're thinking, not only demand is weaker, but also the costs of production are higher. So they want to make absolutely sure that whatever they produce can be actually sold. Otherwise, they're having to finance a double cost, because they're getting less than what they were getting last year, but at the same time it's costing them more. So it is a kind of like a difficult situation to be in right now. If on the one side you have the government through the monetary committee that is hell bent on creating a new recession, and you are just trying to make ends meet as a business and weather the storm and just wait for things to become a little bit clearer so that you can start planning and actually growing again. So as you can see now, this is kind of like just to make you understand how tight the monetary policy is right now. Okay, so this was the last crisis in between 2015 and 19. Now the average 30-year mortgage rates were about 4%. And now with the latest rises, we have gone to about 6.5% and climbing towards 7% almost. And also the 10-year borrowing costs are now almost 100 basis points. So that's 1%, which is significant. I mean, on a long-term borrowing cost, than they were a few years ago. So it's tighter. It's more expensive to do business. It's more expensive to get a mortgage, to get a loan, and so that's the real money, so to speak. Okay, so this is the way the money is created, not by so much government printing, but is by you taking out credit in the forms of consumer credit, mortgages, loans, etc., etc. So there is less money that is going around in the economy. So this is why I can't quite understand how they speak of everything being so rosy, but at the same time, with the tightening monetary policy and less money going around the economy, so slowing down the speed of money apart from anything else, it's almost like an impossibility to at the same time having growth in earnings. So the prices that we see in the stock market and not so much because the companies are making more money, but simply because the valuations are higher. So you see what I'm saying? Instead of you buying a stock because they can give you a certain return over time, you're just simply paying more for the same stock. The return hasn't changed. Actually, it's become worse, but the price that you're paying for something is actually gone up. And this is kind of the last of these slides I wanted to show you. I've shown you this before. Now this is the inverted yield curve. So is when basically short-term loans are the return on the 10-year loans yield is actually lower than the return on a 2-year yield. Okay, so generally speaking, if you commit your money for long, you would expect to receive more interest than if your money is more available, so you commit it for a slower period of time. But at times of uncertainty, like we are at the moment, this curve inverts, and now at the moment the short-term yield is higher than the long-term yield. So we've had that again in the 80s, we had in 2000, we had in 2008, and now we also we've had it in 2020, and it's actually been going for longer than it ever has been going before. But the actual jobs market, I say, is not, again, it doesn't react immediately to this. It will take time to to then show in the real economy. The last time it was 21 months. Okay, now so it could take several more months to show in the economy, to see actually job numbers deteriorating. So remember that job numbers are one of the main indicators that the Monetary Committee looks at when deciding how to set the interest rates. And this is the first time that we're seeing for a while these numbers get slightly worse. So it could be, it could be the tip of the iceberg, or it could not. We'll see. Tomorrow after this release, everybody maybe, if we get a good number here, the euphoria will come back into the market. Everything is fine. We're going to be all right. Everything's growing, and we don't have to worry about recession at all. Okay, and it's a slightly crazy way of looking at things, but this is, we can only report what we see. And now let's go and have a look at some of the crypto news. I mean, I don't have too many to show you today because there is not really much new to report. And let's have a look first at Bitcoin. Oh, sorry. I'm just renewing my drawings. So if as you can see, this is a kind of a 1 hour chart. Let me go to the 4 hour chart. Not much has happened since, again, I always have got this in the way. I can never see what I need to see. Oh, sorry, let me just move the zoom. You can't see these, but my zoom control was in the way. So we're still on the same range that we've been in from the end of June. Okay, and we have tested the 31,000 level. As I told you, I'm not really that interested until we break the 32,000. But we have really been into this, this range here now for a couple of weeks. There has been a attempt to break out, and yes, we had this kind of jump from 25 to about 30, but nothing more than that. And we're still in, as you can see, we are still in this, the range that we had from May and June of last year. It goes between roughly 27, 28 to about, sorry, which was the level? Let me go up to about 32, 32 and a half. Okay, so this is what I kind of like expect. The moment that we get some momentum, and it will take probably some event to break. As you can see, this area that has been quite stubborn. But the moment we actually break this with some momentum, then this will be the next level where price will probably pause. Okay. So again, we are the 38 to 42. So we've spent months really between 25 and 31, and then it'll probably take 2 or 3 days to go between 32 and 40. Okay, that's the way it works. Now, the things have changed slightly in crypto. Okay, and there are some dark currents that we're going to discuss today as well. We got some ETFs, spot Bitcoin ETFs. They are filed. They're trying to create this, an easy way for people to invest in Bitcoin. There's regulated, in the stock market, but all attempts so far have been rejected by the SEC. But if that was to be approved, then there would be a big wave of money finding its ways towards Bitcoin. Okay, and at the same time, we've had, we've been talking every week about how the US is going all out to fight all the crypto actors they can find. Now, the latest news that we have to report today is on Binance and Kraken. So not only, we had some news about some of the main figures leaving Binance. So there have been quite a few departures reported. Now, I never thought I would say this, but I don't know at the moment how safe Binance is, because they are really targeting it really hard. Because what I'm thinking about, especially with BlackRock trying to get into Bitcoin through a Bitcoin ETF, we might be going through an attempt from traditional finance to own crypto in a way. Okay, and Binance is probably the biggest obstacle that there is at the moment, because obviously it's the largest exchange in crypto, and I can't control it. It's unpredictable. Okay, so they are trying really to destroy. And the time we've had news of the founder of Kraken always being investigated. Now, again, that doesn't mean that he's actually done anything wrong. Obviously, the fact that there is a criminal investigation is almost like telling everybody, look, this guy has done something bad, but until it is proven, doesn't mean that it is real. But those are probably the two largest, apart from Coinbase, they are the two largest cryptocurrency exchanges. So the fact that they've been targeted, and by the way, Kraken has already settled with the SEC in the US. So this is they can't go after them in that way anymore. So they find another way of going after them. Okay, so at the moment, I would just say no exchange at the moment, I would say, is 100% safe. Okay, I can't say what's going to happen tomorrow. These are all private companies, and the authorities have got the capacity to wreck them, basically. Okay, so for the sake of safety, I would say don't keep any significant funds on exchanges unless you need to use them or exchange them right now. Transfer as much as you can out of exchanges and into wallets that you got control of. So remember, not your keys, not your crypto. So all the time that you entrust your coins, your tokens to somebody else, there is a chance that something will go wrong. Okay, it will go wrong in the sense with those companies, and they may go bankrupt or whatever. They might get hacked, and you might lose access to your funds. Okay, so just to make sure with all this that's going on, I'll just say, be safe. Better safe than sorry. Now, another unfortunately bad news. Still probably one of the parts that at the moment is the most dangerous in cryptocurrency are bridges. Okay, bridges is what you need to move assets between one blockchain and another blockchain, and that often means depositing coins in a bridge and then creating equivalent tokens on another blockchain. Now, one of the main bridges is called multi-chain bridge, and that operates in dozens of blockchains. Okay, it is the main blockchain for some, the main bridge for some of them. On others, it's just one of the bridges available. Now, apparently, there's 121 millions that have been drained from multi-chain bridge. So not only it is recommended, as you can say, that you suspend the use of multi-chain if you need to bridge any asset, but also to go into your wallets if you have some contract approvals related to multi-chain and just revoke all permissions that you're giving to the bridge. Okay, so I don't know, probably you might not have ever used it before, but if you have, then go and check and make sure that you revoke all permissions. Now, on other news, we're talking about the fight between the real cryptocurrencies and the central bank digital currencies. Okay, now in China, this is already a reality. Okay, when you were thinking, you see what happens in the US right now. In China, it happened a year before. So pretty much like they destroyed the cryptocurrency sector. And now, not because they thought that there was anything wrong with it, but simply because they couldn't control it. They couldn't control Bitcoin. So they made sure that they pushed it out of China, because now they're introducing the digital yuan. Okay, so this is already being used in events, in transport. It's being used in Beijing, and now they have kind of running the Asian games in Hangzhou, and again, the digital yuan is accepted kind of like widely. You can use it in shops, and hotels are accepting this. So this is happening. Obviously, this is the worst case scenario. Okay, there's no, there's no misunderstanding. It's not a nice thing that's happening, because that means total control by whoever's running the CBDC. So in this case, the Chinese state has a total control of seeing and of everything that you do by using the digital currency. So do you want that to happen as well in your own country? Because this is what they're trying to do. It's not anymore. BlackRock has come out actually quite clearly saying it. The CEO just say praising Bitcoin for digitizing gold. Bitcoin could revolutionize finance. Now, from the point of view of the US, they don't want that. They want everybody to use the dollar. Everybody to use whenever they create a digital version of the dollar, they want to use that. They don't want people to use Bitcoin because it's an alternative system. So, and that's what they don't want. They want control at the end of the day. The battle is a battle for control. Simples. Now, if what we were talking about before about spot Bitcoin ETFs, now there are a few, and so that you understand when something. So if one of these was accepted, okay, was allowed to operate, then we would see a big jump in crypto prices. But at the same time, so these are the two events that might happen. Okay, the approval of a spot Bitcoin ETF that could happen. The other thing, the other event, what would happen if Binance collapses? What effect would that have on crypto prices? And we don't know. We don't know because obviously they hold a lot of liquidity. But where would crypto assets go if not on Binance? And it's Binance dwarfs everybody else, by the way. It's much larger than Coinbase, much larger than Kraken, and so on. So we got these two events that could, could be on the horizon. Okay, but these are the dates, just in case you want to be ready. So these are some of the spot Bitcoin ETFs that have been presented. So you can see we got one from ARK Invest, BlackRock, Bitwise, VanEck, and then lately we had one from Fidelity as well, Valkyrie Investment. So there's quite a few in the pipeline. Now the SEC needs to respond by a certain date. Okay, so there's still a lot of time. Like the next deadline the SEC has, and then the final deadline. Okay, but then the earliest that something could happen is the 13th of August for the ARK Invest. For the BlackRock is the 2nd of September. Okay, so there's still plenty of time. Even if something like this needed to be approved. But so just in case you want to make a note of this, I'll copy and paste it in the chat box. Okay, so that you ready a list, and you can keep an eye on these dates. And it doesn't look like they are likely to approve any of this, but at the moment, the biggest obstacle to the approval of a spot ETF is Binance. It's Binance because pretty much they control the because they got the highest volume on there. They are worried that they could manipulate the prices. Okay, so this is at least what has been claimed. Because they say there are concerns about market manipulation, investor protection, and custody. Now, we will see what happens, and if any of these applications will actually get through or not. At the moment, we can only just follow it and be ready. So we can try and be ready as much as we can. But remember at the moment, make sure you have a good wallet. Okay, I would, as I said, we've been talking about it in the last couple of weeks as well. Probably the best option at the moment would be a Trezor cold storage wallet. But there are, just do a search on Google. There are hundreds of wallets available. Ideally, you want to go to a wallet that is open source. Whether it's a hot wallet, so there's software on your computer, or if it's a cold storage wallet, which is like I got one here. Okay, this is a Ledger. Okay, a Ledger wallet. So it's obviously a physical item that needs to be connected to your computer. But also make sure there is a big community. So there is a big community of developers, because you don't want to actually download and use something that maybe was produced a year ago. It hasn't really been updated, so it's got inherent vulnerabilities. Okay, so go for the big names rather than the small ones, and make sure you're safe. So I'm not going to tell you buy this or buy that, but do your own research, and remember, not your keys, not your coins. Okay, let me stop sharing, and let's take some questions. We got, today I've stopped myself with 10 minutes left, so we have got time for some questions. Anybody? Just feel free to unmute yourself. Eric.
Morning, Luca.
Hi, good morning.
Good morning. I take all the money out from Binance. Binance collapses. What impact does that have on me? What scenarios?
It's, I mean, the impact is a guess. I mean, short term, it could be a large impact. It could be a big shock to crypto prices. But to be honest with you, it's, we've had similar cases recently. They haven't quite impacted the price of crypto that much because I think, compared to a year ago, 2 years ago, and the crypto users are a little bit more savvy and they're more aware of the other options. So although we've seen we've seen a lot of cryptos leave exchanges and find their way to self-custody wallets. So what's going to happen to the price? I mean, if Binance it's a really big, it's a big deal, okay, because it's the largest exchange by far. So it could be that in the short term that could cause a collapse in crypto prices. Could happen, so nobody knows really. Nobody knows. But at the same time, we got now, with all these involvements, when you get like Coinbase and Coinbase, Fidelity, BlackRock, all the big boys now are making noises about crypto. That means that there is serious interest. So whatever happens in the short term is one thing, one concern. What happens in the medium to long term is another thing, because we do know that there is going to be serious institutional involvement at some stage, and at the same time we got the Bitcoin halving event next year. Okay, so that's now less than a year away. So when that happens, normally it's followed by a period of fast growth for Bitcoin in particular, and then the rest of the crypto world follows. So I don't know. I wish I could tell you a straight answer, give you a straight answer. I simply don't know what could happen. But at the same time, if Binance collapses, at least you want to make sure that you don't have anything on there that could collapse with it. Then what happens to the value? That's we'll see. Time will tell. Okay.
Thank you.
All right. Okay, and just, by the way, I just remind you again to go and follow also Jonathan's session that starts shortly after this one finishes, okay, at 9:30. It's everything. Jonathan is real crypto head, not like me. I'm just a fan. I'm just a fan. Jonathan is the real deal, okay? He's a Cardano operator, so he does run the network as well, and his session is focused on obviously on Cardano, but also other things as well. So I would say we have the Jonathan, the what's it called? Oh, I don't know. I can't think straight, but it's almost like the dream team. Okay, so yeah.
Friday morning.
Session, yeah, one session, like a small pause, to refresh yourself, and then second session.
Yeah. So Luca gives you the scary news, and then you come to Cardano Q&A and learn how to become self-sovereign.
Exactly that. So, is there a way to measure institutional crypto investors to individual investors? Well, you can measure this kind of whale analysis, what is called on Bitcoin, and you can get that. You can get that on chain. You can get that on sites like Glassnode, for example. So yes, there are, and you can, obviously, you can decide yourself what an institutional investor is. But once you get over, I will say the 10 million mark, you can be, pretty sure that it's some serious investor. So there are, you can measure how the gold kind of different names, from shrimp to whale, to different sizes of investors. They have kind of less than a certain number of Bitcoin or more than a certain number. So you can see how it changes in time if the big investors are growing, or if they are, if the smaller investors are growing more. But recently there has been the one trend that we have seen in Bitcoin in particular is that kind of like one-way direction, one-way traffic of investors buying and never selling. So there is kind of this supply shortage really of Bitcoin, and this is why I think the SEC has been so reluctant in approving a spot ETF, because there's a difference between a futures ETF and a spot ETF. The futures ETF is just a derivative, so it just takes its price mainly from the spot price. But if you have a spot ETF, that means that the investors will go and buy Bitcoin on the open market, so that will push prices up quite significantly. And they can't have all of a sudden a SEC sanctioned investment that can return something that the stock market can match. Can you imagine that? If you have something that you can say almost reliably can return 100% plus a year, who would buy shares anymore? It's a real problem for them. So yes, there is. You can. I say the best way is going on signing up to Glassnode and getting a few drafts from there. Okay. Any other questions, guys? Anne-Marie is showing us some yoga moves and some stretching. No. Eric, another question. Yeah.
Yeah, look, with the interest rates going up and up and up, in a few months also the mortgage rates were going up and up and up. And with the interest rates going up, especially in America, the more banks are failing, and then they have to bail them out. Isn't that counterproductive to raise the interest rates and make a new inflation that way?
Yeah, it is, and that's what they're trying to balance out. That's why we're talking about the Goldilocks effect, So, because in a way, their target is they have to control, their mandate is to control inflation, but at the same time, they need to keep the economy at a certain place where it can carry on growing without overheating. Okay, and that's the difficult thing, because the tools they have to do that are very blunt tools. So raising interest rates long term, it will get inflation down, but in the short term, it's a very blunt tool, because you raise interest rates today and the effects will be felt a few months down the line. So the worry is that because of political pressure, because they have to be seen to be strong, to take action, we are taking the tough action here, and the worry is that they overdo it. Because the inflation is already coming down quite rapidly. I mean, in the US now we are close to 3% inflation. So the worry is that by pushing too hard, then they drive the economy into a recession. We'll see. It's especially here now that we are kind of like in the UK, is hitting everybody quite hard, because we've gone to periods where you finance your house at 2% or less, and now everybody that refinances is kind of like facing 7% interest rates and so on. So it's a big it will have a big effect, but not straight away again, because people have fixed rate deals, so you only have to pay the extra cost when you refinance, and that may be 3 months, 6 months down the line. So there is I'm talking about the UK obviously because I live here, so I follow that a little bit more closely. But there is a large number of loans that need to be refinanced next year, and that will hit really hard. So we are talking about hundreds of thousands of loans that need to be refinanced, and it's not just mortgages for individuals, but also companies. And when you look at places like London has been like a construction feast for the past 20 years. Now the skyscrapers don't have tenants anymore. And these kind of like multi-billion projects need to be refinanced. Something really hard will hit, and will crash. I mean, it is going to happen. It just when, we don't know exactly, but it is going to hit. We've seen we've seen in the US already the commercial sector is finding really really tight corners, and many of the small banks have already gone down the path. So exactly, if they raise interest rates much higher than this, especially with the inverted yield curve that we're still in that situation. So just remind you, banks get finance at short term and then loan at long term. At the moment, the short term finance costs more than the long term loans, so they're losing money. They're losing money on. So that's why they're not issuing new loans as much. Or if they are, the ones that are ask for a lot of money now, because simply they need to add that differential. So they need to charge more than what they are charged. So it's a really tough situation to grow without breaking anything. But I think generally speaking, every time we come out of one of these crises is by breaking something. So something has got to go, has got to give. And anyway, so what gives first we can discuss, but something will give.
Thank you.
All right. Okay. Anybody else? Or we'll finish. I'll leave you to your Friday day. For those of you that are on the other side of the world, to your Friday evening. Okay, so you can go out and relax and have a drink. There's still a few hours to go for me until I can do that. But if you're in Australia, New Zealand, then go and have a raise a glass on me as well. And if you're in the UK, then we might do that together in about a week. Yeah, because we're going to have hopefully for those of you there on the call, they are part also at AIW, will come and join us in a community day and have some fun together. So we got apparently we got axe throwing on the cards. Okay. So I always wanted to do that. So come and join us and have some fun. Okay, hopefully we can do that before we started having a few beers. That would be a bit too dangerous. Okay. All right. So guys, I wish you all a lovely weekend, and I'll catch up with you next week. All right. Goodbye, everyone. Bye.
Thank you. Bye-bye.